Hey everyone, welcome back to another exclusive podcast from IronFX, where we're dedicated to bringing you the absolute best education to help you take your trading to the next level. I'm your host, Desmond, and today we're diving into one of the most debated topics in Forex trading. Should you be a short-term or long-term trader? This question is a bit like asking whether you prefer espresso shots or a slow brewed coffee. Both get the job done, but their experience and approach are completely different. And here's the thing, there's no universal right answer, but there is a right answer for you personally. Let me break down what we're actually talking about here. Short-term trading is when you're in and out of positions within minutes, hours, or at most a few days. You're basically riding the waves, catching quick movements in euro-dollar or dollar-CAD. Long-term trading, that's when you're holding positions for weeks, months, or even longer, right? You're thinking about the bigger picture, like where gold might be heading based on global economic trends. But right, let's talk about what really matters, right? Which style actually works, right? Short-term trading is incredibly seductive, right? The idea of making quick profits, being in and out, right, before lunch, it sounds amazing, right? And yes, when it works, it feels fantastic. You can catch a 50 pip movement in euro dollar in just a few hours, but here's the reality check. It's emotionally exhausting. You're glued to your screen, watching every tick, every candle formation. Your heart races with every small movement against your position. I've seen traders age 5 years in 1 month doing this, and the statistics, they're not pretty. Most short-term retail traders lose money, not because the strategy doesn't work, but because emotions take over. Fear and greed become your worst enemies when you're making split-second decisions. Long-term trading, on the other hand, is like playing chess instead of ping pong, right? You're looking at fundamental factors, right? What's the Fed doing with interest rates? How's the European economy performing? You might hold a position in euro dollar for 3 months, riding a major trend. The beauty here is that you can actually have a life. Check your positions once a day, adjust your stops, and let the market do its thing. Here's my hot take, and this might ruffle some feathers. I believe most traders should start with longer-term strategies. Why? Because it forces you to think like a real trader, not a gambler. When you're holding dollar-CAD for a month, you need to understand why the Canadian economy might strengthen or weaken. You need to grasp oil prices' impact on the Canadian dollar. This knowledge makes you a better trader overall. Think about George Soros shorting the British pound in 1992, right? That wasn't a day trade. It was a calculated long-term position based on fundamental analysis, right? He made over £1 billion because he understood the bigger picture, not because he caught a 5-minute chart pattern. But here's the thing. Your personality matters too. If you're someone who can't sleep knowing you have an open position, long-term trading might stress you out more than day trading. Know yourself. Be honest about your risk tolerance, your available time, and your emotional control. My advice? Master one style before trying the other. If you're working full-time, start with swing or position trading, holding trades for days or weeks. Learn to read the market's rhythm without the pressure of constant monitoring. Once you're consistently profitable, then maybe explore shorter time frames if you want that additional challenge. Well, that's it from me for today's podcast. I hope you found it useful in understanding which trading style might work best for you. For more such amazing educational content, be sure to subscribe to our podcast here at IronFX.